Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Shruti Mishra. These are the top headlines from the startup world. Softbank's Vision Fund managing partner Nagaraj Kashyap, along with Priya Sai Prasad and Samir Kumar from Microsoft Venture Capital Fund M12, float new fund Touring Capital to back AI startups. Touring also made its first investment by leading $85 million Series C1 financing round in AI-powered software for digital marketers platform Pixis.
Deepika Padukone picks up an undisclosed stake in Gurgaon-based specialty coffee chain Blue Tokai Coffee Roasters. Done through Padukone's investment entity Car Enterprises, this fund infusion will form a part of Blue Tokai's Series V fundraising round.
Former Swiggy executive Anuj Rathi joins Jupiter as Chief Product and Marketing Officer. At Jupiter, Rathi will lead product design, growth and marketing. He will work closely with the neobanking startup's founder and CEO Jitendra Gupta.
Fintech industry body announces a new code of conduct for digital lenders. New norms include seeking customer info on existing debt obligations and giving clear options to them to give or withdraw consent on use of their data. The code is mandatory for all 44 of its lending members.
SEBI's deadline seeking public comments on its proposed clampdown on unregistered financial influencers ends today. Financial influencers tell CNBC-TV18 that all shouldn't be painted with the same brush. Adds SEBI must differentiate between those creating educational content and those pushing trading tips.
AI is going to solve the issues that mankind couldn't solve in the past.
A day after SoftBank's chip designing company Arm made a strong debut on Wall Street, Masayoshi Son says artificial intelligence can surpass human intelligence. That's a CNBC exclusive.
Those were the headlines that we're tracking for you this evening on What's Brewing Today. Bollywood actor Deepika Padukone has picked up an undisclosed stake in specialty coffee chain Blue Tokai Coffee Roasters. Shruti, tell us a little bit about this investment, but also this isn't Deepika's only investment into a startup. So take us through her portfolio as well.
That's right. Superstar Deepika Padukone has invested in specialty coffee brand Blue Tokai Coffee Roasters. This undisclosed investment is part of the company's Series B funding round and adds Deepika Padukone's investment entity Car Enterprises to its portfolio alongside A91 Partners, Anicut Capital, 8i Ventures, TSP BlackRock, Negan Capital, Modern Capital and White Whale Ventures. Now, this investment also comes at a time when Blue Tokai completes 10 years of making specialty coffee a craze in India. Deepika is now a veteran startup investor who says she wants to partner with homegrown brands. She has invested in Atomberg Technology, Bellatrix Aerospace, Blue Smart, Front Row, Epigamia and Super Tails. Deepika also launched her self-care brand 82 East in 2022. Well, celebrities clearly are no longer just brand ambassadors. They now seek a stake in the success of companies. Most investments have been made in the direct-to-consumer sector, with some in edtech, e-commerce, food tech, health and fitness and agri-tech sectors. In fact, just last week, Reliance Retail picked up a majority stake in Alia Bhatt-owned Edamame. Well, as they say, picture abhi baki hai, so keep watching this space for more.
Picture abhi baki hai for sure. Lots of celebs taking to startups and investing in them at this point. Now, in global news, Softbank-backed Arm climbed 25% on its Nasdaq debut, selling about 95.5 million shares, the biggest IPO of the year. The chip design company's market capitalization stood at $68 billion at closing. This is higher than the value of Nvidia.
We are going to see some very, very profound advancements around AI going forward. The ChatGPT moment, if you will, I think was a tipping point relative to what the capability of these large language models could do. So on one level, as a CEO of a company that builds a lot of devices based on AI and an engineer at heart, phenomenal opportunity. And I think for us going forward, back to the CPU being the center of everything, and you can't really run AI without a CPU, it's going to be a huge growth opportunity for Arm.
And speaking of artificial intelligence, Masayoshi Son sat down for a rare interview with CNBC. He was gung-ho about the potential of artificial intelligence, saying it can even surpass human intelligence. He expects artificial intelligence to solve several issues that seem unsolvable today.
I'm a big believer of AI. Since I started SoftBank, I was a big believer of, the microprocessors enabling all kinds of technology evolution, starting with PC and then mobile, internet, and then now going into AI. It is front end of all the innovation of our industry. The core is the microprocessor. So ARM is now going to become the core of the AI revolution. My belief of the front end of the IT industry's evolution is really shifting to AI. So my focus, my belief is all centered in AI, and ARM is going to become a core of that. Many of the Vision Fund portfolio companies, we have about 500 companies, they are going to be, having a lot of great applications of AI, and they're going to be beneficiary of this ARM and many other AI technology players.
Masa, if you had been in that meeting with a lot of the leaders in AI that just took place with Senator Schumer and other members of Congress, what would you have shared? I mean, you just said it's going to exceed our own intelligence. There are those who are quite frightened by that prospect and worried about the dangers of AI. Do you share that?
Well, if we mishandle it, it has a danger. Like automobile society, it has a danger of the car accident. If you don't regulate, the automobile society is regulated with a traffic light and speed limit and don't drive with alcohol drinking. So AI society should regulate to protect humankind. However, it has more merits than the demerits.
Meanwhile, e-commerce retailers could see sales rise 18 to 20% this festive season. This, according to data from consulting firm Redseer. Shilpa Ranipeta is here with more. Shilpa?
Well, this year's festive season that's just around the corner is expected to clock about 90,000 crore GMV this year, and this is about 18 to 20% higher than last year. Now, remember last year the festive season came somewhere between September to about end of October, and at that time last year about 76,000 crore rupees was clocked. And this time, however, this calculation of 90,000 crores by Redseer is going to be somewhere between from the end of September until the mid of November, basis when the first e-commerce sales actually start. And Redseer has also said that in terms of trends this time, unlike every time where electronics leads sales, they're saying that this time they could see more sales contribution coming in from high margin categories like beauty, personal care, home, general merchandise, fashion, etc. And also with the trend of premiumization, the average selling price also this year is likely to be a lot higher. There's a bet on D2C brands also growing well this year. And remember, this comes at a time where there has been a consumption slowdown that we have been seeing on the back of high inflation. In fact, sales have been at record lows on e-commerce platforms in the last couple of quarters, and GMV in fact grew only 10% in India between Jan to July 2023 as compared to the same period last year. So Redseer is expecting that this festive season will sort of catalyze this slowdown that we've seen and boost growth once again. And one last interesting piece of nugget of information that I want to leave you with is that this year also marks 10 years of e-commerce sales starting in India, with the first one happening in 2014. And at that time, from then to now, the annual GMV in fact has grown 20 times. So when in the whole of 2014, we just saw GMV of about 27,000 crores, this year they're estimating post the festive season that it could cross 5.5 lakh crore rupees. Back to you.
All right, Shilpa, thanks so much for those details. Appreciate you joining us. Moving on, Fintech industry body announces a new code of conduct for digital lenders. My colleague Ritu Singh has more. Ritu, over to you.
In what's brewing today, the Fintech Association for Consumer Empowerment, or FACE, has come up with a new code of conduct for digital lenders to advance consumer interests and safeguard against any harm. The code is going to be mandatory for all 44 of its lending members, which represent close to 50% share in retail unsecured digital lending through digital lending apps. These fintechs are expected to implement the changes to align with the code in 3 months' time. Joining me now to talk about the significance of this is the CEO of FACE, Sugandh Saxena. Sugandh, welcome to Startup Street, and thank you again for your time here on CNBC-TV18. You know, we've seen a significant spurt in unsecured retail lending by fintechs. And while it comes with the positives, there are also negatives, specifically when it comes to unethical recovery practices, which have come to light in the last couple of years. How does this code address some of these challenges to safeguard customers?
So, digital lending industry does very huge number of volumes. And, as you said, it has really spurred the financial inclusion in this country, giving a lot of consumers who don't have any access to credit. This code really looks at a lot of learning which has happened over the 3 years, as you said, recovery practices, data protection, cybersecurity issues, and very explicitly covers very clear set of norms for our members and also for the industry as a whole to ensure that this doesn't happen. So if you look at the code, our earlier code has just 2 norms when it comes to recovery practices. Today, we have 10 norms saying what exactly has to be done when it comes to recovery practices. So this code is much more granular, much more clear set of rules for a member so that it's very easy for them to implement them. And we really hope that this will help all the members to really push the benchmark in terms of customer protection.
But Sugandh, if you could give us specific examples, how does this take forward RBI's digital lending guidelines, which talk about similar measures for customer protection? What is in this conduct which is not already covered by regulations?
For example, if you look at RBI digital guidelines, it covers a lot in terms of disclosure and the transaction. But if you look at our code of conduct, we have focused very much on the appropriateness, right? So when we talk about appropriateness, when we say that it's starting with customer onboarding, so getting the right set of documents, understanding their repayment capacity and therefore underwriting to be very robust, service them in an appropriate way so that they have all the information necessary for them. And if at all they're not able to pay, a very systemic process to deal with debt stress if that happens. So what we have tried to do with this code of conduct is within the regulatory parameters, define much more rules and clear guidelines for our members, which they can follow.
What is the sort of conversation you've had with the RBI and the industry to evolve yourself, as we understand, to become the SRO for fintechs in India?
We are very focused on the fintech lending segment, right? So fintech is a catch-all term, right? There are different product segments and each product category comes with its own set of nuances and risks. And therefore, I'm not sure whether even regulators thinking an all-encompassing SRO. But for digital lending, this is something which RBI has already articulated in August last year that they would like to have a SRO for digital lending. And there, as I said, our members cover very significant market in terms of volume. And we are very well positioned to be an SRO for that particular segment, which is fintech lending segment.
What is the next step? Is there legal or is there recognition from RBI about FACE being the SRO for digital lending fintechs in India? Is there consensus among the industry on your role?
So I think as a members, self-regulation really self-regulation. So as members, our mandate first comes from the members who give us the remit to say, you frame the rules and you enforce the rules. So that's the most powerful thing for us. And we will start enforcing those rules in a very impartial way through an enforcement committee. Regulatory recognition is certainly very important. Whenever RBI issues a separate guidelines for SROs in digital lending sector, we would again apply. We have already applied, but whenever specific guidelines come for the digital lending, but that doesn't stop us from doing right thing, which is self-regulating the sector.
Give us a sense of the growth trajectory from here on. To what extent will digital lending grow in the next year or so, and how much market share in the long to medium term do you see digital lending having in the overall retail lending pool?
So I think retail lending in India is roughly, 55 lakh crore market. It's a very huge market. We are, if you look at in terms of value, we are just about 2% of it. But fintech lending has to be measured on the metrics of volumes. And when it comes to volumes, our members alone do 7 crore loans, which is a very huge number. Outlook is very, very positive because we all know India remains highly underpenetrated market in terms of credit. there is a huge demand which is still available with the economy growing and all the fundamentals remain intact. We foresee that fintech lending will have a very important contribution to make in terms of meeting domestic demand. And therefore, we have a huge long runway ahead of us in which multiple players can thrive and meet that demand. So outlook from our perspective is very positive. However, I would like to say that differentiating factor would be the value creation which fintechs do in terms of keeping customer at a fore. And any lender who is able to achieve that through proper risk management, governance, and customer protection practices, there is no limit in terms of growth.
All right, Sugandh, thank you very much for sharing your thoughts with us.
On that note, it is time for us to head into a short break. But coming up next, sources tell CNBC-TV18 that Mamaearth is prepping to go public in November. My colleague Aishwarya Anand brings us a special report on the other side. Stay tuned.
Welcome back to Startup Street. Honasa, the parent firm of omni-channel consumer brand Mamaearth, is preparing to hit the public markets in November. Sources have told CNBC-TV18 it has also begun roadshows before investors. Aishwarya Anand brings more details on this story. Take a look.
Direct-to-consumer platform Mamaearth is getting ready to launch its IPO. Sources tell CNBC-TV18 that the company may hit the Lal Street as early as November if all goes to plan with its roadshows. The firm has already held roadshows in Mumbai and is currently meeting investors in Singapore and Hong Kong. Mamaearth's parent, Honasa Consumer, set out on its IPO journey in 2022. The omni-channel retailer got SEBI's nod to list in July. The D2C unicorn is eyeing a valuation between $1.4 to $1.6 billion, sources have told CNBC-TV18. According to its draft papers, Honasa's proposed IPO comprises a fresh issue of equity shares worth up to Rs 400 crore and an offer for sale for 46.82 million shares by promoters and existing shareholders. The draft prospectus also states that the shares of investors like Fireside Ventures and Stellaris, along with partial units of founders Varun and Ghazal Alag, would be up for sale. Others selling their stakes partially include Bollywood actor Shilpa Shetty-Kundra, Rohit Kumar Bansal, Sofina Ventures and Kunal Behel. The founders collectively own 43.5% stake in the company, while Peak 15 partners, Fireside Ventures and Stellaris are the major stakeholders with 20.94%, 15.01% and 11.24% stake, respectively.
Even when we filed, right, it wasn't the best of the conditions, right? And today the conditions are far better. There is far more FPI in the last 2 months, which has sort of started to coming into India, right? But I think we are not even looking at some of those short-term indicators, right? We are in it for decades, right? And this is just an event in that journey, right? And if you are in it for decades, right, you would rather chase the long-term value creation.
Founded in 2016, Mamaearth started as a D2C baby care products brand. Gradually, it forayed into the beauty and personal care segment. It currently sells products ranging from makeup, hair to body care. Honasa also owns in-house brands including Aqualogica, The Derma Co, Dr. Sheth and Be Blunt through acquisitions. Mamaearth acquired parenting platform Momspresso in 2021. Amid a bid to improve profitability, it shut the Momspresso My Money platform due to its increasing losses. Mamaearth was valued at $1.2 billion when it raised $52 million in January last year in a round led by Peak 15 partners. It turned profitable in FY 2022 with a standalone net profit of Rs 19.8 crore as against a net loss of Rs 1,332 crore in the previous year. The company is soon expected to submit its FY 23-24 financials for the planned listing by mid-October as per sources.
Focus, of course, is on a sustainable business and growing sustainably. So I think in any brand's life, or in any, for that matter, business's life, there are phases, right? There's a growth phase when you're investing disproportionately to grow your base, to get to more consumers. Then there is a phase where you're trying to work out your unit economics and see that, okay, this growth is sustainable. And then there is profitability, like we call it, right? That you're able to grow the business profitability and get the juice out of it. So I think we are on the third phase right now.
Only 2 Indian startups have listed on the stock exchanges this year amid investors' increased focus on profitability. Drone maker IdeaForge's IPO saw an overwhelming response and its shares listed at a 94% premium to the issue price. Meanwhile, Udis Solution listed at over a 12% premium. This is Aishwarya Anand for CNBC-TV18.
It's Friday and it's time to take stock of all the deal action from the startup world. According to Venture Intelligence, this week saw a total of 11 deals worth $284 million. Some of the notable deals include B2B SaaS fintech unicorn Perfio Software, which got $229 million from Kedara Capital. Kale Logistics raised $30 million as a part of Series B from Courageous, while crypto exchange Brian Fee attracted $16.5 million as a part of Series A from Pantera Capital. Now, Elevation Capital, Goodwater Capital, Upsparks and others also invested. That's not all. Female hygiene brand PSafe backed $3 million from Rainmatter Capital and others, while fractional holiday homes ownership platform Hotel Yari raises a little over $2 million from Alios Ventures. We have seen a total of 403 deals this year, valued at $5 billion, according to Venture Intelligence.
Thanks for that, Arundhati. Moving on, with climate change posing a big risk to human civilization, fast-moving clothing brands like H&M and Zara are taking steps to cut down their carbon footprint. H&M will be selling second-hand clothes at its London flagship store, giving a platform for sustainable fashion. Xenia is here with all the details. Xenia, what have you picked up?
Amid growing concerns around the negative impact of fast fashion on our environment, fashion brand H&M has decided to sell second-hand clothes and accessories at its London flagship store starting October 5th. The garments will be sourced from Flamingo Vintage Kilo, a company that runs second-hand vintage clothes stores in Europe and the United States, and will be priced from £29.99 or $37 to £189. H&M has acknowledged that it is part of the problem and that the way fashion is produced and consumed needs to be changed. It will be the second H&M store to offer second-hand clothes after Barcelona, which opened earlier this year. Meanwhile, last week, another clothing giant, Zara, launched its online second-hand service in France, having trialed it in Britain since November last year. So why are these big fast fashion brands selling second-hand clothes? It is largely due to the growing concern around the dark side of the fashion industry. According to the UN, the average person buys 60% more clothes than 15 years ago. Every second, the equivalent of one garbage truck of textiles is dumped in a landfill. Not to mention, to make one pair of jeans, it takes close to 8,000 litres of water. Even a simple cotton shirt requires close to 3,000 litres of water. Moreover, the fashion industry is the second most polluting industry, right behind big oil. The fashion industry not only produces 10% of global carbon emission, but also contributes 20% of wastewater production. So considering these factors, H&M and Zara are the two big brands taking climate-conscious steps to reduce emission. The question now is, which other brands will follow suit?
So fast fashion brands like becoming climate conscious. Thank you so much for those details, Xenia. But with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching.